So, Daniel, thank you for inviting us today. With so much uncertainty in the world, we really welcome the opportunity to have this conversation about the financial markets and its impact on the real estate market with a senior financial advisor and a real estate expert. So, why don't we go around first and introduce ourselves? Should we start with you, Daniel?
Uh, sure. So my name is Daniel Risman Jones, and I am a real estate agent here in San Francisco. Have been working in the business for 11 years. I got in right at the bottom of the last recession, so I saw the build up to the peak over the past 10 years, and have now seen the whole cycle. So I'm very excited to be speaking to both of you because this is definitely an interesting market that we're in right now.
Yes, we live in interesting times. Sabrina?
Great. I'm Sabrina Lowell, and I'm the managing partner of our San Francisco office. And something that I love about how we work with clients is we get to partner with folks and help them make better decisions about their money. And so, especially in environments like this, I think that's really when the coaching side of our skills come out. It's not just about the technical knowledge and expertise, but also being able to help with the behavior management through really tough times when emotions can get high.
Oh, thank you. And I'm Sheila Schroeder. I lead business development for Private Ocean. And to build on Daniel's point, one of my first days in the market was October 19th, 1987. So I've seen a lot of crashes, but I've also seen a lot of recoveries. And so we know that it's not a matter of if, we know it's a matter of when. And this is a great time to begin the conversation. So I'll start with you, Sabrina. Given the current economic uncertainties, what actions are you suggesting folks take?
Yeah, it's interesting. Maybe just stepping back, big picture, I would say a lot of the market downturn that we've already experienced is really around the fear factor and not necessarily the underlying economic pieces. And so I think as the market continues to digest some of the information that's coming about, we'll see some additional volatility here. But right now, there's been a real price dislocation between where things are priced and the underlying values of those companies. So with that in mind, what we're really telling folks to focus on right now is what are the things that you can control and what are the things that you can't control. So you can't control what the market is doing, but what you can control is how you're exposed to the market and what your strategy for that exposure might be. And specifically, the other things that you can control is how much news that you're consuming and the actions that you're taking and sticking to a plan. And then the other piece that I've been having conversations with clients about in the last couple of weeks are just coming back to the basics around what can you control around expenses, for example, and sitting down and coming back and looking at what are things that might be on the horizon for the next, call it 6 to 12 months. What are your income streams and what are your outflows? And then are there any major goals or purchases like real estate that might be on the horizon where it makes sense to come back and revisit what is that strategy and what are the actions that you might want to be taking there?
Thank you for that. Well, so Daniel, I have actually two questions for you. From a real estate perspective, what strategies are you currently suggesting to clients? Number one. And two, does real estate make sense in the current market environment?
Yeah. So first off, thank you for the question. I want to just reemphasize the point that Sabrina made is to really look at where you are, how you are exposed to the market, make sure that you are take stock of your cash on hand. So for clients who I'm working with right now, they are looking at how much money do they have in the bank account, how much money they have in stocks, can they still afford to buy real estate? I think does real estate make sense right now? If you have the cash to make the purchase and you have a job that you feel is fairly stable, the coming, the market that we're in and the coming marketplace is going to be one of the best opportunities that anyone who, who's been, been in the workforce has seen in the better part of 10 years. So now is a great time to think about buying real estate as long as you have the ability and option to go ahead and do so.
Okay, that's great. And then, so that actually brings me back to you, Sabrina, in terms of maybe thinking about how real estate fits into an overall financial strategy. I know you work with, when you're working with clients, you're really looking at their entire portfolio holistically, including their real estate. So could you maybe talk about that?
Yeah, we're big fans of a diversified strategy, and as you alluded to, looking at the full financial picture. So while we're focusing on what their liquid assets might look like and how they're allocated to the market across stocks, bonds, and alternative type assets, we're also having a lot of conversations with clients about real estate, and especially here in the Bay Area. Oftentimes that can be one of a client's largest assets, either their primary home or second home or investment real estate. And I think that people like the idea there's a familiarity with hard assets where you can go and touch that asset and people understand kind of how that works. And I think that the other piece that is a real advantage in holding real estate is that you can use leverage in order to control that asset. So as Dan was talking about, being able to have a down payment, but using maybe 20 or 25% to control a much larger financial asset that'll grow over time as part of someone's net worth.
That's a great answer. Thank you. Could we maybe move to, in terms of, here's another one for you, Sabrina, is with all the economic stimulus money being injected into our economy, what do you think are the implications for the financial markets?
Well, I think first and foremost is probably consumer confidence. Markets, as I was mentioning earlier, are right now digesting information. And we saw as the CARES Act was coming to fruition, we did see a nice bump in the market. And while we've seen still some up and down days in the meantime, maybe some stability around a floor, at least at current. And really with the injection of that money, I think that there is some talk about or maybe concern around, does this mean that there's inflation coming, right? The government is printing money. And really what we saw, if we look back to the '07 to '09, is that with quantitative easing, now the Fed is injecting money into the marketplace, and we're putting money in motion so that consumers will spend, but it doesn't necessarily mean that we'll see inflation pick up in a big way. And what I mean by inflation in that way is, your everyday sort of living expenses. Although, of course, here in the Bay Area, we might see food costs increasing slightly, and I would think that housing prices as well. But your everyday kind of CPI or inflation, I think that the Fed's going to keep an eye on that and trying to keep that low. The other advantage really too, with interest rates being low, is that lenders can access capital, or borrowers can access capital from lenders at lower rates. We're seeing a lot of clients who are looking to refinance, and obtaining new mortgages for our clients is appealing at this time, where they're well positioned to be in the market for real estate.
Terrific. Thank you for that. Well, so Daniel, I'd love to go to you and ask you, what do you think the implications are for the real estate market, and how some of the programs that are being implemented by state and local officials, how do you think they're going to impact the Bay Area market?
Thank you for that question. And I actually wanted to do one response to what Sabrina said regarding the interest rates being low in refinancing. Another opportunity that we have right here, and something that I'm looking in personally, is taking out a HELOC on an existing property. So interest rates are extremely low. You can be looking at lenders to access the equity you already have in a property So if you need that for security, but also if you need that to invest in some other opportunity, talk to your financial advisor. But if you needed that money to invest in a better opportunity where you get a better return on your investment, you could start looking at other ways to find some sources of equity, some sources of cash for investments right now. Then to go to your question about what we're seeing, your question was about the implications of the real estate market based on what the local officials are doing.
Yes.
So, unlike in the financial crisis, most owners in the Bay Area and in countrywide didn't have a huge amount of equity in their property when the last financial crisis hit. Now we're seeing that most people have been buying properties with 20% down, 30% down, all cash. And we've had a huge amount of appreciation. So at this point in time, we are not really expecting, at least in the Bay Area or other major metropolitan areas that are very competitive, that the marketplace is going to go down so low that we see the same number of short sales and foreclosures that we saw back in 2008, 2009. Specifically in San Francisco, we're still in a housing crisis. We still have a large amount of demand with not enough supply to ameliorate that demand. And also in San Francisco, the tech companies are still performing better, as good or better than ever with work at home. A lot of tech companies are being bolstered in this time period. So I'm not expecting the loss of jobs that at least citywide that helped create the housing crisis before in 2008, 2009. But one of the big things that the local and government and state officials are doing here in California, but also in other metropolitan and state governments, they're waiving the ability for landlords to do evictions on properties if their tenants are being affected by COVID-19 and not paying rent. So for the mom and pop, investor who owns one property or a couple of properties and have a lot of exposure, they may very well see the next several months as a time when they may not be able to pay their mortgage, when they may have to let go of a property because they're not getting the rental income any longer. So I could very well see that though most properties may not go underwater, that there may be enough equity for specifically apartment buildings, tenant occupied properties, those ones that are going to be very exposed to the market, and a lot of those properties may become available in the next coming months. So if you're looking to pick up an investment property, if you've been thinking about buying a small 2-unit, 3-unit, or a larger building, then over 6 to 12 months from now, you might see a lot of those becoming available and at a discount on the marketplace.
So what I'm hearing you saying is that definitely there are some potential pitfalls, and you've got to be aware of what's going on. And that's truly where your expertise comes in. But it also sounds like that there have been lessons that have been learned from the great financial crisis, and that a number of buyers are better prepared, and a number of owners are also better prepared. And there hasn't been as much speculative activity as we saw between 07 and 09.
I wouldn't say that. I mean, I think there are lessons learned, and I think that at least the big banks in California have been, I believe, instructed by the state officials to assist the homeowners, so that in case people can't pay mortgages, that they're more capable of deferring payments, so that there isn't a huge wave of short sales and foreclosures that we did see in 2008, 2009. But I also think that because we are in San Francisco, and then you look at the greater Bay Area or the greater metropolitan areas of a lot of cities on the West Coast, those areas you don't have the same speculation because you don't have the housing stock that allows for speculation. But if you go to other communities where there is more suburban sprawl, those areas still have seen a lot of speculation. they have seen a lot of wholesalers, flippers, once again, mom and pop, small local people that may own 5, 10, 15 properties. Though those communities I do think are going to be hit harder than what we see in San Francisco. During the last financial crisis, we saw about a 18, 20, 25% reduction in value in our properties, specifically in San Francisco. But even if you go 30 minutes, 45 minutes outside the city, that's when you saw properties go down as much as 50 and 60%. I still think those areas are going to be hit much harder than what we see in San Francisco proper, or some of the more high in demand areas.
Okay, thanks for clarifying that. I really appreciate that. So that actually takes me to my next question for you, Sabrina. For people who are counting on using their stocks to pay for the down payment, can they still qualify to buy real estate?
Well, it depends, right? So if the market is off of its highs by, call it maybe 25 to 30%, that could have an impact on what people can afford. I would say that those who are sitting on large cash balances are going to be well positioned to take advantage of some of the opportunities that Daniel was talking about. And as typically as we're working with clients and looking at what might be on the horizon, we're usually having clients set cash aside maybe 6 to 12 plus months ahead of time in order to make sure that their down payment is in stable funds. And I get a lot of questions around, gosh, I'm sitting on all this cash. Like, is there anything better than putting it in a money market that is virtually paying zero? There are still some money markets, tradable money markets at brokerage firms that might be in the 0.5 to 0.7 range. So we're oftentimes seeking those out, or CDs that maybe have no early withdrawal penalties. But having that money in a place where it's there when you need it makes a lot of sense. But when we talk about, buying real estate and during these markets, if you don't have cash set aside, then I think a real opportunity. So one of the strategies that we're using right now with how markets are, exhibiting more volatility is rebalancing. So essentially selling assets that may be more stable and buying equities. One option would be to look at, I think, especially for people who have, for example, concentrated stock positions, where if you look at the original purchase price, may have been well before market highs, and therefore you're still exhibiting a lot of growth in that particular position or embedded gains. There can be an opportunity to say how much, while we're not at the market highs where we were last year, this is a behavioral finance term called anchoring, right? Anchoring to what that very market high was. If you look at where we are relative to where the purchase is, if there's a gain, could you sell some of that concentrated position, therefore reducing your risk exposure, taking some of that gain, and then maybe if you have other portfolio assets that are currently at a loss, selling those, staying exposed to the market there though, but capturing that loss and therefore offsetting the tax impact that you would normally experience in order to liquidate those shares, and then coming up with cash that could be available for a down payment. And I would say when you're looking at strategies like that, liquidating stock positions or concentrated stock positions to make that cash available in these types of markets, thinking about what is an acceptable return from, again, when you originally purchased that security, and then also depending on where you are or where the market is now, thinking about what are price points where you may want to look at selling those shares. So if today's value isn't quite where you want it to be, if it increases, say 10% from where it is now, and with some of these market moves, that could be, in the short term, going ahead and pulling that price target and pulling the trigger to sell those shares to make the cash available for a down payment could be a good strategy.
Well, the way you outline it really makes clear how valuable it can be to have a financial thought partner when you're thinking through those strategies.
Yeah,
So thank you.
there can be a lot of moving parts. So
Right.
understanding what are the implications of using one strategy with these types of assets and then another strategy with other assets, I think, and having a coordinated plan makes a lot of sense.
Thank you for that.
Can I jump in on just respond to Sabrina, at least what I see on the real estate side?
Yes, because I think that there must be creative strategies that your buyers are using. So yeah, please add.
Yeah. So I just want to go back to the idea of anchoring the viewpoint of the owner, the seller of their assets in real estate, or any assets that they own. When I talk to my buyers before they buy a property, often every buyer has a question: what about a recession? What about a recession? You know, what if the market drops? And I tell them, you know, if you're in this for a 3 to 5 year period, that you're going to be fine. Even if the market goes down, by the time you hit the 4th or 5th year, the market will have rebounded. During the last recession, we saw in San Francisco was about a 4 to 5 year holding period from 2008 to about 2011, 2012, before the market had rebounded, where you could sell your asset again and at least break even on the purchase price. Other communities took a little bit longer, but you know, that 4 to 5 year holding period was, you know, what most people experienced right now. And that was about, like I said, an 18 to 20% drop in value in San Francisco. I would expect that from the high of a couple months ago that we have seen probably about a 10% drop already. But in San Francisco and most of the Bay Area, we're seeing a 5 to 10% appreciation annually. So even if you bought your house 3 or 4 years ago, you should still have equity in the property from the time that you purchased. So it's really just anchoring the viewpoint of, you know, what is the value now versus when you purchased it, or versus the height, and what, you know, acceptable return you're willing to take on the property. So then to go into your question, Shayla, about creative strategies right now. As I mentioned, I think there are opportunities out there for buyers who want to either, you know, expand their real estate holdings or get into the market, because sellers are much more motivated. They are feeling wary about the market. They may want to. For them, the most important thing is to find the secure buyer who likes the property and who wants to close. So no, it might not be any longer that it's the highest price offer that takes the a multi-counter situation, but it might be the most secure offer that takes the buyer, that the seller can accept their offer, or it might be that you're just the only offer on the table. So in this environment, buyers who are more conservative, who have been looking for a lower value property, getting in with a deal, this is the time to really start putting in offers. You can go in and offer and put in $100,000, $200,000 less than potentially the asking price. I've heard of significantly more, hundreds of thousands of dollars less than the going asking price, or what properties were valued at a couple months ago. But if you have a good significant cash down, you have a good team behind you, you have the financial advisor, you have a strong real estate, you have the strong lender, you can really paint the picture of yourself and your team as having a very secure position for the seller, so that they know that even if your offer may not be the top offer, it's a secure offer that will close on the property. So going in and finding deals, is definitely this is a great time for that. If you need to buy properties with family members, with friends, in order to buy that larger property that you've been thinking about, this is also a time when you can go in with more creative offers. You can have multiple people on the offer. You could be borrowing money from parents. You can be going in with less cash down. There's been a lot of opportunities now with going in with 5%, 10% down offers, and now those are being considered a lot more strongly because they may be the only offer on the table. So we are working with people who have VA loans. VA loans have not been as competitive in San Francisco because there are other requirements that the VA puts forth as far as inspections, So for a long time, sellers hadn't really considered them, but now is a great opportunity because you can use the great benefits of a VA loan without, if you're the only offer on the table. You can also put in more contingencies. So if you have to sell your property in order to purchase a property, throughout the rest of the country, there tends to be the opportunity to have a contingency for the sale of the buyer's property in order to close. In the Bay Area, we don't often see that because it is a competitive situation. But now, once again, if you are the only offer on the property, you have the ability to put in more contingencies or more buyer-friendly contingencies so that you can actually transact and close on a property. And then I've also heard recently that people are putting in offers with seller financing. So seller financing can allow you to have more interesting terms that may be better for your situation, even better than what a bank is able to offer. And in this environment, you can go in with these very creative solutions in order to purchase a property.
What I'm hearing from you is that being creative is really is welcome, and people are thinking outside of the box.
Certainly, yeah. This is the time to be creative, to be working with someone who's experienced. Mm-hmm. For example, going back to seller financing, the aspect of seller financing is that you might be able to put an offer in that on a price-wise is more acceptable to the seller, but term-wise, because of the financing aspect of it, is more acceptable to the buyer. So you can come up with these solutions that you may not have been able to do in previous real estate market.
That's great. And clearly you are adept at understanding each of these different ways to do the financing. And I'm sure you can guide your buyer and your seller through each of those scenarios. Could we then move to another question? Having said that, where do you think the biggest opportunities exist? And are there any areas that you would avoid, Daniel?
I think the biggest opportunities that exist right now are for investors looking at tenant occupied properties, multi-unit buildings, small apartment buildings. In the next several months, you're really going to see a lot of those coming on the market. And during a slowdown, a recession, a downturn, the price per square foot drop in a multi-unit building tends to be much greater than that in a single family home or in a condo. So if you're looking to pick up additional properties for your portfolio, I would definitely start looking at multi-unit buildings starting in a couple months, going back to the fact that small landlords may not be able to cover them if a tenant stops paying rent for 2, 3, 4 months. Commercial spaces may be an interesting thing to look at over the next several months. With shelter in place and work from home, how that affects small offices, commercial buildings may be very interesting, whether or not people do go back and flock back to the office, or if people are more lenient with work from home and maybe office space may not be as needed as much. Retail spaces as well, because of now people are doing a lot more shopping online, retail spaces may change. And then once again, looking back at more suburban areas where I mentioned those areas are going to be hit hardest. There were still flippers, there were still wholesalers that owned a lot of properties. Those areas will tend to see a larger downturn than San Francisco proper and some of the surrounding communities in the peninsula. So if you wanted to pick up properties at a much lower price, price per square foot. So here in San Francisco, you're still looking at $800, $900, $1,000 or above per square foot. Out there, there are areas you can find $200, $300 per square foot. You might be able to pick up multi-unit buildings or rental properties outside the city for a much less price. That's
really helpful. I know with our firm, we've spent easily the last year or so working on earthquake preparedness, and to make sure that all of us could work seamlessly with each other and with clients. And for us, fortunately, because of all the work our CEO and our firm had done on earthquake preparedness, who would have thought a pandemic would trigger it? But all of us have been able to literally flip the switch and work seamlessly from home. So I suspect that might impact our office space needs in the year ahead. And I think we're not alone in that. So thanks for pointing all of those out.
Yeah, and there was, sorry, one more thing I wanted to point out was I've talked a lot about the buyer side of this, but I also want to give the opportunity for a seller. If a seller has been waiting in a while to purchase their trade up property, if you've had your first kid, your second kid, you're a growing family, and you wanted to trade up into a larger home, even if your property may be devalued at this point by 10%, 15, 20% off of what the high of it was, it also means that that bigger property you may have had your eye on is likewise devalued at a similar price point. So, and if you're trading up into a more expensive house, then the relative gain that you get is worth it to sell and buy during a lower down market, rather than waiting until your home rebounds as well, because then your next property will also be relatively more expensive. So it is an opportunity for sellers, especially with those trading up, to be purchasing at the moment to be selling their property.
Great. So on both sides, there are opportunities. Yeah. So Sabrina, what mistakes should people avoid as they consider how to grow their wealth in the next 5 to 10 years?
Well, I think especially given where we are today in the market, I would say a big don't is switching strategies right in the midst of a market downturn. If there's anything that we learned from the '07 to '09 and working with clients through that market down cycle, it was those that stuck with the strategy and specifically stayed invested in the market, continued to rebalance. So that means as the market declines in value, selling the assets that may have performed the best in these markets. And right now that would be assets like bonds or alternatives, and rebalancing into the equity asset classes that we have seen sharper declines in, stocks, domestic, international, emerging, continuing to have exposure there and buying more shares, so that as in '07 to '09, as the markets returned, because we know that they will, it's not a matter of if, it's a matter of when. Having those additional shares participating means that your portfolio will rebound more quickly than if you weren't rebalancing during those market conditions. So I'd say that can set folks up for to be well positioned in the next 5 to 10 years. And now is not a bad time to be getting into the market or deploying additional cash, because price points are off market highs. So I think hindsight is always 2020, but looking back for those who put money into the market in probably in this calendar year, I think will fare well. And I think just, looking at your overall strategy, I mean, we really think of, as we talk about managing your finances, thinking about it as, your own, sort of like managing your own business, right? Your personal finances are your business. And so being proactive, and it's not a set it and forget it, it's setting a plan. It's like when you set sail for Hawaii, you can only sit on the back of the boat with a cocktail for so long. You have to make sure that you're steering to make sure you get to where you want to go. And so 5 to 10 years can be a long time frame, but making sure that you're purposeful throughout that, maximizing 401k, looking at how real estate, from this discussion might fit into your portfolio, and being able to incorporate that into your overall financial picture, rebalancing, and I think having a good team in place also.
So you guys have been great. We've gone sort of broad, macro, we've gone a little bit more granular with the micro. Any final words of advice? I'd like to start with Sabrina.
Well, as I mentioned, it's not a matter of if, it is a matter of when. Markets always recover. They always have. If we look back through any market downturn, we have always come out the other side. So I'd say this year can be a buying opportunity.
Great, thank you. And Dan?
Yeah, I'm just to reiterate what Sabrina said. It's not if, it's when the market rebounds. There's always going to be some opportunity in real estate. It's making sure that you are able to find that opportunity, and having the realtor, the lender, the financial advisor in place that can really help you get all your ducks in a row so you're ready to make that jump in when you're able to do so. But the other thing I also want to recommend is there are, in California, they have allowed a lot of they have really pushed lenders to allow for mortgage deferment. So this is the time that you really are trying to take stock of the money that you have on hand. A lot of lenders are allowing you to defer payments. So talk to your lender if you're having any concerns, any issues, so that if you need the assistance, there may be some assistance there from the banks that hold your mortgages.
So clearly, thank you for that. Clearly, transactions are happening, whether they're happening in real estate or working with advisors, they're definitely happening. And my key takeaway from this conversation is that the value of experience, expertise, and working with a team really cannot be underestimated. And every day we hear the news, we hear the news feed, but it's really what you do with that data that leads to a stronger potential outcome. And working with the right team to build a strategy can really make a difference. I want to thank you, Daniel, and your business partner, Stephen, for inviting Sabrina and me to chat with you today. We're really happy we can be a resource for you. And yeah, thank you.
Thank you so much. It was a pleasure to talk to both of you as well.
Yeah, thank you for this conversation today. It's been a learning.
Well, be well, be healthy.